Hi folks, in this question we're going to do journal entries related to shareholders' equity, specifically share retirement and share dividends, and we're going to prepare the shareholders' equity section of the balance sheet. It's a good idea to have the question with you as well as the solution so you can follow along. So let's begin. In the first journal entry, or in the first piece of additional information, they tell us that we're retiring Series A preferred shares. In this question, you do have to be a little bit careful because we do have two share types when it comes to preferreds, Series A and Series B. Because we're retiring the Series A, we're going to remove each Series A share, $25,000, based on the average issue cost, which is the total equity paid in, which is $12.1 million, divided by the total number of Series A preferred shares that we have at the date of the retirement, which is January 15th, and that's 480,000. So when we do so, rounding to two decimal places, we get $25.21. So we remove those 25,000 shares at that average issue price to get $630,250. We also know that to retire those 25,000 shares, it cost us $31 to buy them back from the investors, which is more than what the investors on average gave us at $25.21. Because we do not have any contributed capital on Series A preferred shares, we can't debit any contributed capital, so we need to debit the difference, which is $144,750 to retained earnings. On February the 1st, this is testing the concept to see if you know how to handle a share issue when you get not cash, but a non-cash or any other asset or consideration for that asset in exchange for those shares. In this case, you had to remember that when those 80,000 common shares were issued, you were going to issue them or credit the common share account based on the value of the machinery. That's an IFRS requirement. So we're going to debit the machinery based on its known value, which is $1.6 million. The only time you would ever credit the common shares under IFRS for its market value is if you did not have the market value for the machinery. On March the 11th, what we did is we retired, in this case, not Series A, but Series B preferred shares. So we need to figure out what's the average issue price of those 15,000 shares. Well, if you look back at the question, we see that we have $10,500,000 in preferred shares Series B equity, and we have 100,000 Series B shares outstanding at the date of our retirement, which is March the 11th. So when we divide $10.5 million by 100,000, we're going to get $105,000, which is the average issue price we're going to use to remove the 15,000 preferred shares Series B from our books, and that gives us a debit to that account of $1,575,000. You'll notice that we did pay more to retire those 15,000 shares, which was $116,000. So now I have to make sure that we debit any contributed capital on those Series B preferreds, and if not enough, then the retained earnings. It so happens that we don't have enough. We do have $101,000, but we can use it all to retire those shares. Notice we couldn't use this contributed capital account, by the way, when we did go and retire the Series A preferreds, because this contributed capital here is related only to the Series B, not the Series A shares. We would now go ahead and debit the balance to retained earnings to balance our entry, and that's $64,000. On April the 30th, we retired some common shares. So now what we need to do is we need to calculate the average issue price at that retirement date, April 30th. This was a little trickier because you had to go back and find out the average issue price. Don't forget, on January the 1st, we had common shares, the number of shares, 1.2 million, and the carrying value or book value was $18,600,000. But don't forget, on February the 1st, we just issued some more common shares based on the market value of the machinery, and we issued 80,000 shares for $1.6 million. So we have to factor the number of shares on that date with their carrying value at the date that we're retiring the shares in order to come up with 1.28 million in shares, with a book or carrying value in our books of $20,200,000, and that will give us $15.78 rounded for our average issue price in the common shares that we're going to use to remove those 60,000 shares. So now, on December 31st, it said that we declared a share dividend. So when we declared the share dividend, we have to calculate how many new shares are issued. Well, we can do the calculation. We know that we have 1,220,000 shares to calculate the share dividend on. How do we know that? Well, if we look here, we know that on April the 30th, in this case, we notice that when we're issuing the common share dividend, because it's declared and paid at the same date on December the 31st, we have to calculate the number of common shares that are being issued on the date of declaration. Normally, so you know, share dividends are not declared and issued on the same date, but in this case they are, so we have to credit the common share account right away. But for how much? Well, we have 1,220,000 shares, so I just did a little asterisk here, double asterisk, to show you how we calculated that. You remember on April 30th, to calculate the average issue price, we had at that date 1.28 million in shares. But don't forget, on that date, we also retired 60,000 of them. So if we deduct those 60,000 from the 1.28 million shares, we get 1,220,000 shares, upon which we're calculating our 10% share dividend. So the number of new shares that we'll issue here based on this calculation is 122,000. The question told us that we're going to be issuing those new shares at the market price at declaration date, which is $22 a share. So that gives us a debit to the share dividends account, or you can debit retained earnings directly, and a credit to common shares of 2,684,000. So now, let's continue with our problem. Now that we've done all of the entries, we can go to the next area and look at the solution. So what I've tried to do here in the solution in this requirement is put it together so that you could see right below what the calculations are for the equity section. We know, first of all, we need to make sure that we do the equity section in good form, so we should always put together a 3-line title. And I've put mine together there. Now, to calculate all of the amounts in the contributed capital section, we're going to start with the preferred shares, Series A, then Series B. We know that there's 75-cent dividend, but we notice that we only have 455,000, not the 480,000 that we started with in the question. So how did we get that? If we go down here and look at our calculation for the Series A preferreds, we notice that we had 480,000 at the beginning of X2, but don't forget on January the 15th we retired 25,000, and that gave us 455,000. So we'll put that there. Now we get 11,469,750. How did we get that? You'll notice at the beginning of the question, at the end of December 31st, 2000X1, we did have 12,100,000 in preferred shares Series A equity. But don't forget that on January the 15th, if you go back to your entries, we did debit the preferred share account on the retirement of those 25,000 shares for $630,250. And that debit reduces our preferred share Series A equity to 11,469,750. So that's our number there. With the Series B preferreds, we did have 100,000 shares originally issued and outstanding, but now we only have 85,000 because you'll recall on March the 11th, we did retire 15,000 of those shares. So that leaves us with 85,000 shares in our equity section. The value of 8,925,000 is derived from the fact that our preferred share Series B equity was 10,500,000 when we began the year. But don't forget, on March the 11th, when we retired these 15,000 shares, we removed them from our books at 1,575,000 based on our average issue price, again at March the 11th. So that leaves us with 8,925,000. Our common share equity, we have 1,342,000 shares issued and outstanding. And how did we get that? Well, don't forget, we started off in our calculation with 1.2 million in common shares, the number of shares at December 31st, 2000X1. On February the 1st, when we received the machinery in exchange for shares, don't forget we issued 80,000 shares to get that machinery. And don't forget again, on April the 30th, don't forget we retired 60,000 in common shares. So that left us with 1,220,000 shares issued and outstanding at April 30th after this retirement of 60,000 shares. But don't forget, We added 122,000 new shares on December the 31st when we declared our share dividend. So we now, with the share dividend that we issued, plus the 1.22 million in shares that we had at April 30th after the 60,000 share retirement, we now have 1,342,000 common shares, which we will place in our equity section here. How much share equity is that now? Well, again, if we go down here, I'm just going to go to another page to do a T account to show you how we arrive at 21,937,200. We ended X1 at 18,600,000 in common share equity. Don't forget, again, when we issued the common shares for machinery, we credited the common share account for 1.6 million. On April the 30th, when we retired the common shares, the 60,000 shares, we removed them from our books based on the average issue price of 946,800. And then we issued more common shares at December 31st when we issued our share dividend. So that gives us 21,937,200, and that will go in our equity section right here. So we're going to total our contributed capital to get 42 million, I should say, $331,950. Now to calculate our ending balance and retained earnings. I did do a little T account down here to help you track, or you can just look at the statement. But to follow the T account through, we started with 14,600,000 at December 31st X1, which ended the previous year. In the current year X2, what did we do? We retired, you'll remember, Series A preferred shares, and we needed to debit retained earnings on January 15th when we did that for 144,750. On March the 11th, when we retired the Series B, we debited retained earnings for 64,000, and then on April 30th, when we retired the common shares, we debited retained earnings for 373,200. We also debited our retained earnings when we declared our share dividend for 2,684,000. You can see that again in your journal entry. The question also told us that we did have income for X2 of 1,609,000. So now we wind up with $12,943,050 in retained earnings. So we're going to place that in our retained earnings section here, and we're going to get total shareholders' equity in the equity section of $55,275,000. So this concludes our shareholders' equity presentation along with the journal entries that led up to these balances. I hope you found the video helpful.